Our next topic is on closing entries. The purpose of the closing process is to reset the temporary accounts for the next time period. The temporary accounts are the accounts that we close. Over the next few slides, I will show you how to do this. First, we close our revenue and our expense accounts. These accounts are closed to a brand new account that you have not heard about yet called Income Summary. Income summary is an account we only use during the closing process. It summarizes the net income, hence the name, income summary. Once we close the revenue and expense accounts to income summary, we then close income summary to our capital accounts. Lastly, we close the withdrawals account to capital as well. These are the only accounts that we close. The permanent accounts do not get closed and stay open. These include assets, liabilities, and owner's capital. These accounts stay open because just because it's a new time period does not mean they go away. If I had a liability, a debt, it does not get erased because it's a new time period. My assets, such as buildings and equipment, do not disappear because of the new time period. We still have it. On the other hand, the temporary accounts do close so that we can keep track of our revenues, expenses, and withdrawals for the next time period without being combined with all other time periods. An analogy that gets used is scoring at a sports game. When you see two teams playing against each other for a game, the scores always start at 0 and gets reset for the next game. Imagine if scores were never reset and carried over from game to game. It just would not work. Books are closed annually, but they can also be closed monthly as well. All of the closing entries will flow through to the capital account. There are 4 steps in the closing process. The first step is to close any revenue accounts to the income summary account. To close an account, you subtract the balance out by doing the opposite of its normal balance. For instance, revenue has a normal credit balance. That means to close it out, we will debit that account. If we debit the revenue account, we credit the income summary account. This is what the journal entry would look like. If there is more than one revenue account, you would also include it in this journal entry. You would have 2 debits for the 2 different revenue accounts, and the income summary would be the total of both. I will demonstrate this with the expenses next. The second step in the closing process is to close the expense accounts to income summary. Expense accounts normally have debit balances, so in order to close them, all expense accounts will be credited. If those accounts are credited, then income summary will be the debit. This is an example of what it could look like. We list income summary first as a debit, then we list all of our expenses, no matter how many there are. We total all of our expenses together, and that will be the amount for income summary. Remember, debits still need to equal credits always. Now that the income summary balance is the amount of net income, we can close that account. You will either debit it or credit it depending if there is net income or net loss. In all of the examples and assignments that I give you, there will only be net income, no net losses. With that being the case, income summary will be debited and the owner's capital account will be credited. If there was a net loss, these would be switched. The revenues and expenses actually get closed to capital, but they make a pit stop on the way. They first get close to income summary, then income summary gets closed to capital. The amount here is the amount of net income. One of the biggest mistakes I see in this step is students using the balance of the capital account instead of the income summary account. The capital account is not being closed because it is a permanent account. It is absorbing all the other accounts. The final step is to close the withdrawals to the capital account. Withdrawals normally have a debit balance, so to close it, you do the opposite, which is a credit. If withdrawals gets the credit, then capital gets the debit. It makes sense because capital normally has a credit balance, so the withdrawals are actually reducing owner's capital. This is what that journal entry would look like. Owner's capital gets the debit, withdrawals gets the credit. This is a summary of all the entries made in the closing process. All the accounts end up being closed to capital. Your best bet is to memorize these steps. We will do a practice example next. We will be going over question number 2, part A on your classwork. The following adjusted trial balance contains the accounts and balances of Cruise Company as of December 31st, 2017, the end of its fiscal year. Prepare the December 31st, 2017 closing entries for Cruise Company. The revenue and all the expense accounts and the withdrawals accounts will all be closed into capital. The rest of the permanent accounts up here will stay the same. These temporary accounts will disappear and the balance in the capital account will be updated to reflect all of these accounts going into this one. The first step is to close the revenue account to income summary. As you can see, revenue has a credit balance of $44,000. To close it, you will need to debit the revenue account. If revenue gets the debit, then income summary gets the credit, and it would be for the amount of $44,000. Let's put that entry in. The date would be the last day of the accounting period. In this case, it's the end of the year, 12/31. We're going to debit revenue to close it out for the $44,000 balance it has. And then income summary just goes in the other spot, in the credit spot. Income summary of $44,000. Step 2 is to close all of the expense accounts to income summary as well. These are all of the expense accounts right here. We have depreciation expense, salaries expense, insurance expense, rent expense, and supplies expense. You see it has a debit balance, meaning to close it, we have to credit it to zero it out. All of these expenses will be credits. Income summary will be a debit, and it'll be a total of all of these. Let's put that in now. We will put in the date as 12/31 as well. Income summary here gets the debit, and then we'll list all of the expenses as credits. We have depreciation expense, and the credit would be $3,000. You're just copying the balance from the adjusted trial balance. We have salaries expense, $22,000, insurance expense of $2,500, rent expense of $3,400, and then supplies expense of $2,200. What we're going to do is total all these up, and that would be the amount for income summary. When we total it, we get $33,100. Now that revenues and expenses have been closed to income summary, we need to close income summary. The date would be 12/31. That's going to be the date for all of it. Remember, as long as we have net income, the debit would be income summary and the credit would be capital, because capital has a credit balance and we're putting our income into capital to make it higher. Now, the hardest part I say here is coming up with the amount. It's the amount of income summary. If you're not keeping track as you go by doing T accounts, then sometimes I see students get a little confused with the amount. I have a little trick though. Just take the total revenue of income summary minus the total expenses of income summary. Revenues minus your expenses will get you your net income. So 44,000 minus the 33,100 would be the 10,900, and we would put that value in. That was my income. That's what's in income summary, and that's what it's closing income summary into capital. Our last step is to close the withdrawals account. The withdrawals account has a debit balance of $7,000. In order to close this, we're going to do a credit so that it zeroes out. And we're going to credit this account and then debit the capital account. Let's do that now. The date is 12/31. We're going to debit the capital account for the $7,000 and we're going to credit the withdrawals account for $7,000. And this is how we close the accounts. Let's go backwards for a moment. Now that we're done with the closing entries, all of these accounts are now gone. The only ones we have left are these ones here, the permanent ones, from cash down to capital. All of these balances stayed the same except for capital because all of these closing entries went into capital. And we're going to be learning about the post-closing trial balance next.